Are mortgage lenders causing another real estate bubble? Find out this week on Tuesday's Tips. Let's talk about what types of mortgages were available back in what we now call the subprime era, and how much money people could purchase properties for out of pocket, and if they could walk away with the closing with cash, and all of those things. And let's talk about what's still available now.
Okay, I'll give you a comparison. There
Okay.
was the NINA, no income, no asset,
Okay.
where you could buy a house, multifamily, non-owner occupied, if you had the right scores, zero down, no skin in the game on an investment property.
Okay.
You definitely would pay higher levels of interest, but there was such a frenzy. There was such a frenzy because real estate kept going up. The whole monkey see, monkey do. Well, if my friend can get an investment property, I can get an investment property. And then you've got, people trying to keep up with the Joneses. That program is back. We have access to that as a broker. There is a lender that we have that'll do stuff like that, but they want skin in the game.
Yeah.
I think as of now, it's been a while since I've even had to look at it, because I'm really reluctant to look at that, because if I truly can't qualify somebody, I don't know. It just doesn't, right now, it just doesn't sit right with me. But for that particular lender, I think they want a 30% down payment, if I'm correct on that.
Yeah.
So big difference.
Big difference.
Zero down on an investment property versus, say, a 30% down payment. So that was the NINA. And then there was also the SISA, which was the stated income, stated asset.
Okay.
I don't even know if that's out there. I really don't know. With us as a company, one of the great things is being in all 50 states, and they do the best as a company to give us the tools to succeed.
Sure.
So we have a whole spot in our company intranet of brokers, available brokers that we can look at for stuff that's not traditional and that doesn't fit in the box. Maybe there is a stated income, stated asset. It just doesn't sit right with me, so it's not something that I've looked at.
Sure. Let me ask you, were there any loan products for people back in the subprime era where if they had bad credit, there was some other way for them to get a mortgage that ended up turning out to not work out?
Yeah, there were, we'd call it was a 228. So it was fixed for 2 years. It adjusted for the remainder of the term. So it was amortized over 30 years.
Okay.
Those programs there were some of those that would go right up to 100% loan to value. So for anyone that's watching the video, loan to value is how much equity you have. So 100% means that you're financing all the way up to that particular value. There were others that, as the score got lower, the loan to value would get less. Maybe it would be 95% or 90%. And then there were other things that we would look at of how someone paid their mortgage, which, as we go for our licensing and as we do our continuing education, as lenders, there's definitely something, let me just say it differently. As lenders, when we're doing our CEs for our continuing education every year, what I see a lot of times, Jeremy, is should you tell someone to skip their payment? You cannot do that. So, and I really think that had to do with the non-prime days, like the Consumer Finance Protection Bureau, the CFPB, who polices lending and keeps everything that we do legal and transparent and upfront to the consumer. Really came down on a lot of those practices. And a lot of those players, I would like to believe a lot of those players are gone. Like I remember one day getting gas, and he looked young. I mean, in my head, I'm like, he's a kid. So the guy that was pumping my gas said, I used to do mortgages. And I'm sitting there in my head thinking, well, why are you pumping gas? You know what I mean?
Right.
Yeah. So
Right.
For me, it's a red flag. Like, yes, some people, maybe they were working for the wrong company, or maybe something happened in the company that they work for, went under. But I think any of the any of the lenders that survived and made it through are the good players. And there's a lot of really good lenders that are out there.
Sure, sure. Now, Suzanne, I remember a story from someone back in the day. They were telling me about, this was during the subprime era that we're calling it now, where somehow their principal was going up every month, but they were making what the payment that the bank wanted them to make. Can you explain a little bit about what that was and just explain it? Because my mind's still baffled and blown by that. I don't understand it.
Yeah, they more than likely were doing a pay option mortgage, which is negative amortization. And that program, if you, you know, the thing is the onus needs to be on the consumer, but the onus also needs to be on the people that are giving the product. Like, think about it, you know, like we get a cup of coffee and it's like, okay, ding dong, it's hot. But there's a reason why it's on there. Somebody burnt themselves. So, but I do think that there still needs to be an onus on the person, you know, if you have the smarts to read, which I would like to believe everyone does that's getting a mortgage, you got to look at stuff. And that was the problem with a lot of lenders, is you had the don't worry about it. Don't worry about it. You'll be fine. Why don't you just make the lowest payment?
Yeah.
So,
And then you can always refinance later.
yeah, we'll always help you refinance, right?
Yes.
Which is a crock of BS.
Yeah.
What happened with that person is they just picked the lowest payment, and that's why their balance was going up. It's what's known as negative amortization.
Okay. So what you're saying is they had options. They could pay different options on their mortgage. One being like I sounds like kind of like the minimum payment on your credit card. Where actually, no, that's not a good example, because then your balance is still going down a little bit. So it sounds like the minimum payment, their principal or what they owed in their mortgage was still going up, but they have other options as well if they wanted to pay more. Is that correct?
They did. They had, from what I remember of it, they had 4 options. So
Okay.
they had, if I'm right, 15 years, 30 years, interest only,
Okay.
or the negative amortization. So the neg-am, for short, would always be a super low payment.
That's
Yeah.
All right, I hope you enjoyed this episode of Tuesday's Tips. I'm Jeremy Bailey, your Flying Realtor. Remember to keep your wings level, and I gotta fly.